Welcome to this explainer. Okay, so today we're taking Peter Lynch's legendary investing framework and turning it into a real actionable playbook for you. If you've ever felt like the Wall Street insiders have some kind of secret formula that leaves everyday folks completely in the dust, well, you're going to love what we uncover here. Because while Wall Street is busy using supercomputers and complex algorithms, Peter Lynch literally used things like his wife's shopping habits to spot massive winners. Let's dive into exactly how you can apply these golden rules to your own portfolio. Right here, we have a classic Lynch quote. Your investor's edge is not something you get from Wall Street experts. It's something you already have. I love this because the traditional narrative tells us Wall Street has all the advantages, right? But Lynch completely flips that script. He genuinely believed that you already possess the ultimate advantage. How? Literally, just by paying attention to the companies and products you interact with every single day. Think about it. Wall Street analysts usually don't catch on to a massive new trend until it's already a giant corporate success story. But you, as a consumer, you spot that packed new coffee shop or that must-have gadget way before it ever hits the financial news. All right, quick look at our agenda. Today we'll be covering the everyday investor's edge, why we need to forget forecasting and study companies instead, checking the balance sheet, hunting for growth at a reasonable price, and finally, surviving the market blizzards. Let's jump right in. Section 1, the everyday investor's edge. Okay, let's look at this number, 29.2%. By literally just investing in what he knew and understood, Peter Lynch averaged a staggering 29.2% annual return, managing the Fidelity Magellan Fund from 1977 to 1990. Just let that sink in for a second. That is absolutely wild. He grew that fund's assets from $18 million all the way up to $14 billion. And the coolest part, he wasn't wildly speculating. He was just finding what he famously called 10-baggers, stocks that grow 10 times in value, by simply keeping his eyes open to the living, breathing companies all around him. Section 2. Forget forecasting, study companies. Look, trying to predict macro trends, like guessing interest rates, political shifts, or exactly when the next recession is going to hit, is honestly like staring into a broken crystal ball. Nobody can consistently do it, not even the pros. So instead of playing this stressful guessing game with the economy, you really need to focus your energy on bottom-up analysis. Your time is far, far better spent truly understanding exactly how a specific business makes its cash, how fast it's actually growing, and the underlying strength of its operations. Focus on the business, not the macroeconomic noise. Which brings us to Section 3, checking the balance sheet to really stress test financial health. Now, spotting a great business story while you're out running errands is awesome, but it isn't enough on its own. Lynch's 10th golden rule, never invest in a company without understanding its finances, is absolutely non-negotiable. The most catastrophic losses in the stock market almost always come from companies with bad balance sheets. Before you risk a single dollar of your hard-earned money, you absolutely must check if a company is actually solvent, meaning, can it actually pay its bills? Because let's be real, a cool product means absolutely nothing if the company is drowning in IOUs. And hey, don't worry, you don't need to be a certified accountant to figure this out. Just keep it simple with 3 vital metrics. You want 0 or very low debt, a current ratio above 1.0, and a super strong cash safety net. Think of the current ratio kind of like checking if you have enough money in your own checking account to cover this month's rent. It just proves the company actually has enough liquid assets to cover its immediate short-term liabilities. Simple as that. Okay, this next quote is quite possibly my favorite truth in investing. Companies without debt can't go bankrupt. I mean, take a second to really process that. It is literally the ultimate defense against market crashes. If you've ever found yourself wondering how to protect your downside risk, well, this is it. It isn't about setting up some complex hedging strategy. It's simply about buying businesses that are fundamentally too financially sturdy to fail. Moving right along to Section 4, growth at a reasonable price, or what we call GARP. So once you verify that the balance sheet is rock solid, you got to make sure you aren't overpaying. Just because a company is fundamentally sound doesn't automatically make it a good investment at any price, right? Enter the PEG ratio. I know it sounds like some boring Wall Street jargon, but it's really just a reality check for a stock's price tag. You just divide the price-to-earnings ratio by the company's historical earnings growth rate. If a stock looks super expensive based on its price alone, but it's growing like a weed, well, the PEG ratio reveals it might actually be a massive steal relative to that rapid growth. When you actually do that math, your magic target number is 1.0 or less. If it's under 1, boom, green light. The stock is attractively priced relative to its growth. Conventional GARP investors use this as a massive rule of thumb. It's basically your ultimate quick sanity check before you go ahead and hit that buy button. Now, after running those numbers, you really have to remember that you can't treat all stocks exactly the same. You need to drop your stock into one of Peter Lynch's 6 distinct categories, just so you know exactly what expectations to set. Are we looking at a slow grower paying a nice, steady dividend, a turnaround coming back from the brink of death, or maybe an asset play that's just sitting on some extremely valuable real estate? You gotta know your category, or you simply won't know how the stock is actually supposed to behave. Try thinking of your portfolio like a fortress. Your smaller, fast-growing companies, the ones growing at 20 to 25%, those are your offensive units. They bring the high rewards and those sweet 10-bagger opportunities. But they definitely carry higher risks, so balancing them out with established stalwarts, which grow at a steady 10 to 12%, acts as your heavy shields. They protect your wealth when the market inevitably gets ugly. In fact, Lynch himself kept about 30 to 40% of his portfolio in these steady stalwarts, just for that exact protection. Which leads perfectly into Section 5. Surviving the market blizzards. Guys, here is the absolute, unavoidable truth of investing. Even if you do perfect fundamental analysis, you still need a really strong stomach. Just look at the history here. Between the post-World War II era and 1997, there were 9 completely separate recorded recessions. 9. They are unavoidable features of the investing experience, not some weird anomalies. And as Lynch bluntly reminds us, nobody rings a bell to tell you a recession is starting. You just have to accept that volatility is going to happen. Which brings us to this legendary insight. A stock market decline is as routine as a January blizzard in Colorado. If you are prepared, it can't hurt you. I absolutely love that. Seriously, don't panic. You've got to view a market crash as a massive clearance sale. It is your prime opportunity to swoop in and buy those debt-free, high-quality companies at absolute bargain prices, all left behind by panicked investors fleeing the storm. So it all really comes down to this. The ultimate secret to building long-term wealth isn't just about having a high IQ. It's about having a strong stomach. It's about having the emotional fortitude to actually trust your fundamental research when literally everyone else is running for the exits. So I'm going to leave you with this to ponder. When the financial weather inevitably turns cold and that next market blizzard hits, are you going to flee in a total panic, or are you going to grab your shopping cart and load up on bargains?